What is up, everybody? My name is Cole. I'm a part-time real estate investor, full-time legacy airline pilot, and a part-time military instructor pilot. Today's video is a real quick one about how to use hard money. I've talked about it in a lot of my videos. I've showed closing statements on what it actually costs to do it. This week, I'm closing on just under 1.8 million in real estate, and I'm using hard money for 3 of the transactions. They're the smaller of there's a $1.4 million 20-unit transaction that's happening this week on Thursday. And prior to that, I've got 3 duplexes that are closing. One's for 150,000, one's for 110, and one's for 120. So the hard money lenders may use for all 3 of those. It's 2 separate transactions, kind of. There's the 2 duplexes for a total of 230, and then the other one for 150. It's on its own. Why am I using the hard money? I'm buying these duplexes for what I believe to be under market value. So I'm going to hold on to these for the 6-month term of the hard money, which I'll explain shortly. And then I'm going to refinance them onto a long-term loan, a loan that I can actually sustain with one of the local credit unions or whatever. You don't want to stay on hard money for too long because you will run out of money, right? So what is hard money? Hard money is basically just like a private bank. It's either somebody rich, it's a private person, or maybe a conglomeration of people, somebody that starts a business. And let's say they go to you and say, hey, do you want to invest in my company? I'll give you a 5% return, let's say. And you give them the money, they give you a 5% return monthly, and in turn, they take that money and they loan it out to investors like me to buy properties with cash. And what's the advantage of that? I can close really quickly. I wrote these contracts for these properties up last week, and I'm closing this coming week. So you can move extremely quickly. You don't have any contingencies. I don't need an appraisal. I don't need financing contingency. And so it makes it really quick, right? And simple for the seller. You don't have to have any hidden things that they're waiting for, no inspections if you don't want one, which makes moving fast really easy. But it comes at a cost, right? So the way the hard money lenders that I work with use, it's a 6-month term, right? So you're going to have interest-only payments with them for 6 months. And to originate the loan, so at the closing table, they're going to charge you 4% of the loan value. So if you're borrowing $100,000, they're going to charge you $4,000 just to start the loan. Then every month you're going to pay them interest-only payments. I've got my phone here with an example of what I'm doing next week. So I'll read it through for you. But the idea is that you get on hard money, you stabilize the asset. You're using this to usually buy unstable assets or things that are really below market value. In the case of these 2 duplexes that I'm buying for $230,000 combined, I believe their value is going to be right around $300,000 to $340,000 for the pair on an appraisal, which will come down the road. So I've got to basically survive till then. I've got to stabilize them. I've got to make them cash flow as best as possible and then get off of the hard money onto something more stable. So the way that it's set up for this deal, loan amount is $230,000. So I'm going to be paying 14% interest only payments. And a lot of you are sitting there like, oh my God, there's no way I could ever pay that much money to a lender. And 14% is a ton. These properties will not cash flow. I promise you. They will lose money more than likely month by month in the hundreds, maybe thousands of dollars a month. But I'm offsetting them with my cash flow in properties that are stable. And so in my mind, it's a short-term pain for a long-term gain. These properties are going to be worth about $100,000 more than what I paid for them within a couple of years. And to me, it's worth the short-term pain of $500 to $1,000 a month in losses. Now, it's dangerous. You can get high on your own supply. Let's say you buy something that isn't going to appraise out in 6 months. Now you're in a tricky situation. You just paid for a ton of interest for 6 months, and now you have to pay another 20% down to get somebody to fund the loan for you, right? Because most banks are only going to lend 80% loan to value, so 80% of what the appraised value is. Back to my deal. Sorry for the rant. $230,000 interest-only payments, 14% interest only, and 4% loan origination fee. So that means I'm paying $9,200 to underwrite these 2 deals. Now, how am I offsetting that? Well, at closing, I'm going to get credited rents for the month of February, which is about to happen tomorrow, and I'm going to get credited the security deposits. Again, I've said this before, but that's not free money. That's not money that just appears out of thin air. I will eventually owe that money back, but in the short term, it helps offset the egregious cost to borrow this money. So the $9,200 between the rent prorations, the security deposits, the water bills, all the things that they're going to prorate for me should wash out to be close to even. It's probably going to be a couple thousand out of my pocket, and I'll let you know what it is when it actually happens. But for now, I'm expecting that it'll be pretty close. Monthly payments are due on the first of each month. The monthly payments for these is $2,683, so $2,683 to get lending for these 2 duplexes. And just to give you an idea, they bring in about $4,000 a month gross for the 2, $6,000 a month for all 3. But in this case, they bring in $4,000. The payments on this alone are $2,600. Don't forget, you've got water bills, you've got taxes, you've got insurance, you've got a lot of other money coming out. So like I said, they're not going to cash flow. But when I bring them to a big bank and I underwrite them properly on a 25, 30-year loan with 7%, 5%, 4% interest, whatever it is at the time, that is going to cash flow, and they're going to be good equity plays for the long term. These are nice brick buildings that you can kind of set and forget for the most part for a long time. That's the reason I want them. My first payment starts on April 1st, so that gives you a little bit of wiggle room, right? We're closing on February 2nd, and I've got until April 1st to make my first interest-only payment. So I've got the month of February and the month of March to try to store up some cash before I start pissing it away, basically. From that point, you've got 6 months. So you've got until August to get this loan out of there. And if you don't do that, you can do the same thing all over again. You're going to pay them another 4%, and you're going to start the whole process all over again. So I've done that before. One property, I did that twice because they had $40,000 in basement repairs that I was not prepared for, and I totally screwed up the deal. I ended up paying way too much interest, and it was a disaster that I caused. That we still have the property, and we're going to have to keep it for probably 20 years to actually make any money off of it. But that's the risk. If you're not prepared to move the deal to a long-term lender, you're going to have to refinance with the hard money, and they are going to crush you because now you're paying another 6 months of interest-only payments too at $2,600 a month, and it goes on and on. So like I said, you can certainly get high off your own supply, and if you do that, you could end up bankrupt before you even start. So it's a product that I don't necessarily recommend for beginners, but it does have a use case. If you can find a property that's beat down, that needs tenants, that just isn't appropriate to take to a big bank, or you're buying it for cheap enough that you're going to have enough equity on the back end to refinance it, it could be a good move. And the reason I do it is because in my last deal that I made a video about, which you may have seen, I bought $500,000 worth of properties with hard money, with no money down except for what it cost to underwrite the loans, which was offset by, like I said, the rents and security deposits and whatnot. I brought that to a big bank. It appraised out for just about $700,000, and I got a new loan on it for $504,000, which just happens to be exactly what I paid for them. And now it's $3,000 a month on the payment. It makes a ton of money, and I'm going to sit back and just let that loan get ticked down over time. So it can work. And in that case, I paid $20,000, $30,000 in unnecessary fees, but I ended up making $200,000 on the equity on the backside, and I could offload those properties if I needed to for a profit. So it can work, but you need to think about why you're doing it, and don't just do it because it's easy money, because it may feel easy in the short term, and it really is. It's as simple as me sending an email usually, but it could be really painful on the back end. Now, I know I went through that extremely quickly, but I want to give you an idea of what I'm doing this week. I've got 1.4 million in 20 units that I'm closing on a normal loan with a normal down payment, 1031 exchange, moving stuff that I sold, old rickety South Side properties in Milwaukee, sold them off, and I'm trading them up for some brick, more sustainable 4-family buildings. It's not going to cash flow as well as the South Side, but the South Side stuff had a lot of capital expense coming. That means roofs, siding, foundations, whatever. That stuff was coming up for those, and it was tens of thousands of dollars, and I got out from under them before we had to put that money in, because a lot of times, and a lot of those capital improvements, you're not going to see the money back. It's not that I don't want to do them. It's just, if I'm going to put $45,000 into roofs on a pair of buildings, it doesn't increase the rent, doesn't increase the cash flow. It makes the property sustainable for the long term, which is certainly important, but it wasn't worth it to me to do that. I'd rather just sell them to somebody else, and somebody else will want to improve the properties, and then I can move into something that's already kind of stable, and I don't have to put as much upfront cash into. So we got that deal, 20 units, and then we've also got these 3 duplexes. So all hard money for the duplexes. I would never do that for a deal of the size of the other one. 1.4 million on hard money would put me out of business tomorrow. So that's the outlook for the week. I'm also going to training for the airline, so I've got a lot going on. Starting 2 weeks from now, I'm going to be kind of MIA, not here. I'll probably bring my camera and try to film, but it's going to be challenging. So that is kind of what's coming up. This week we got just under 1.8 million closing. And then I'll be gone to training. We've got a couple more deals in the works, so we'll see how it all shakes out. I appreciate all of you watching the videos. Appreciate all the comments, all the things, and I'll try to keep putting out some content that hopefully will be useful to people. And I'll talk to you soon.